equity-like returns without equity-like volatility. This is really the goal of any investor, whether you're a high net worth retail investor or a major institutional investor. This is also the concept of risk parity, or spreading asset classes across a portfolio to reduce your downside volatility or risk. But is it possible to achieve these equity-like returns without that equity-like volatility? And why is it so important to a portfolio to reduce that downside volatility or drawdown potential? And this is really at the core of our three-dimensional universal asset allocation strategy. The first dimension is asset allocation. The best place to look to see if it's possible to create that situation is going to be your institutional investors, talking about the endowments and the insurance companies that are able to outperform the S&P 500 historically on a relatively consistent basis. And how are they doing that? And this is the first dimension of our strategy, which is the asset allocation. So if you look at these institutional portfolios, they have a relatively small allocation in publicly traded equities or your traditional fixed income. Now, in our strategy, publicly traded equities are a key component of a portfolio. And if you do want to learn more specifically about our strategies around publicly traded equities and options, certainly feel free to click the button below, schedule a consultation, and we can dive directly into equity strategies. But these institutions may only have 20, 30, or 40% in equities. The rest of their portfolio is spread across other asset classes, which can include private equity, venture capital, private credit, private real estate syndication, structured income notes, structured leverage growth notes, or, of course, other hedge funds. Now, why are they spreading these asset classes in there with publicly traded equities? Well, the answer is a lot of these asset classes on their own are able to outperform the public markets. Some, you give up the liquidity component. But more importantly, they're using the theory of correlation, right? Or asset or strategy correlation, which is simply the relationship between two asset classes and how they move at the same time in the market. So if you have two asset classes that are 100% correlated, they're going to move in the same direction at the same rate at the same time in the market, right? Stocks are 100% correlated to stocks. But if you have asset classes that have lower levels of correlation, or even better, negative correlation, meaning they move at different directions at the same time in an economic cycle, then you have negative correlation. And the best example of a portfolio that's using the correlation at its core is going to be from Bridgewater and Associates, which as of today, Bridgewater and Associates is still the most successful hedge fund ever. They return more value to shareholders than any other fund. And it was founded by, of course, Ray Dalio. And one of the components of Bridgewater, and really the core, was the all-weather portfolio that Ray Dalio created, which the all-weather portfolio follows the concept of what Ray Dalio found to be if you put 4 or 5 or 6 asset classes in a portfolio with low levels of correlation, of course, the lower the correlation, the better, you're significantly reducing your potential for a loss on any given year. Less correlation, less potential for loss. And the all-weather portfolio does that by combining some relatively low volatility asset classes anyway, which are primarily long-term treasuries, commodities, large cap stocks, and some tips in a portfolio that's built to perform in any type of market. So the question comes up though, what if I'm an aggressive investor, 45 years old, I have $5 or $10 million, I want a growth portfolio, should you be in the all-weather equity model? And the answer is probably not, right? You're probably, the scenario I described is more of an aggressive scenario looking for growth. And this goes back to the first example that I discussed, which is these major institutions and how they structure their portfolios. So instead of those low volatility asset classes, like in the all-weather model, like your large cap stocks, your tips, your commodities, the institutional investors are doing the same thing right? By reducing the correlation of their asset classes, having many different asset classes with low correlation, but many of them are higher growth or higher return potential asset classes than that in the all-weather. And that's really what our three-dimensional asset allocation strategy is. It's for investors with $5 million or more of investable assets who typically don't need immediate liquidity, but we build a portfolio comprised of partially equities, but also these other asset classes to have a portfolio with low levels of correlation that's going to mitigate your downside potential in the bad times, but also increase your long-term return potential on the upside. So we're a team of CFAs, CFPs, CPAs, and estate planning attorneys. So if you'd like to schedule a consultation with us to discuss your specific situation or go into our three-dimensional asset allocation strategy in more detail and the other dimensions and the other indicators that we use, we'd be more than happy to speak with you. We hope to talk to you soon.